Hi there, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things lending, finance and investments. And on this video we're going to be focusing on the topic of investors, why only a few people go down the investment property route and why only a very small percentage of the people that get investment properties own more than 5 or 6 properties in this country compared to other countries. So what we're initially going to do is we're going to look through this article, and then the second thing we're going to do is I've written out a 10 kind of point list on the reasons why I think the majority of people haven't gotten past 6 properties, and if you see the stats here, probably haven't even gotten past their first 2 or 3. Alright, so if you like this kind of content, please hit that subscribe button, please hit that like button for the YouTube algorithm, and leave me a comment if you're liking these kind of videos. Alright, so let's jump straight into this one. So we're going to read it out. So according to the ATO, there are just over 2 million property investors in Australia, with a country that's got about a 26 to 27 mil population. Looking at it simplistically, for every 100 people, 16 own an investment property, 84 don't. Of the 16 that own a property investment, again, using the 100 people as a base, 76 had a rental loss, they negatively geared. 24 had a net rental profit. 71 just one investment property. 19 owned 2 properties. 6 owned 3 properties. 2 owned 4 properties. 1 owned 5 properties, and 1 owned 6 properties. Alright, so that's the base level data on what we're going to discuss today, and then I'm going to bring up my list, which you can't see, and we're going to talk through the items. Alright, so I'm one of the 1 in 100, okay? I've got 6 investment properties right now, and they're not little cheapy 50k properties out in the middle of New South Wales in Lightning Ridge or Burke. A good portion of those properties were purchased over 400,000. Alright, so I'm one of those 1 in 100, and these are the things that I've seen not only on my journey, but what I've experienced by what I've seen out there in the public. Alright, so if you want to look at it from an income point of view and a household income point of view, I've done other videos on the channel, so go and have a look. There's 20%, so the top quintile of households across Australia earn more than 280,000 combined household income. So that tells you that there are 20% of households in this country that earn 280,000 a year, and then you quantify that via the stats that we're looking at, and you can see very few of them get past 2 investment properties. And really, people don't find this concerning. All right, people obviously are going down the negative gearing route. All right, so what we're going to do is we're going to go through the 10-point list that I've written out. I'll talk on each point, and then I'll put this in the comment box below as well, so you can follow it as we go. All right, so point 1, negative gearing. Okay, we're going to focus on negative gearing on the first point, but we're going to focus on it from a borrowing power point of view. All right, so when you're buying property, you can either be borrowing property, let's use a 400k property as an example. You could be getting 300 rent per week from that property, 400 rent, and 500 rent from that property, okay, depending on where in Australia it is and what the rents are in those markets. A $300 property would be negatively geared. That means that the rent doesn't cover the outgoings of your interest expense on the home loan and the outgoings on the property. So what happens is you have a certain amount of money coming out of your pocket on a weekly, fortnightly or monthly basis to keep the property there. So most likely you need a 2, 3, 4, 5 grand cash balance sitting in your offset, and then it slowly trickles away over time. And then what happens is at the ATO level, when you lodge your tax return, you show the ATO that you've got a loss. So you show what the difference is between the rent and the expenses. And if that difference per year, let's use a very easy example, is $3,000, Then you apply that to whatever your tax rate is, and 3,000 times if you're in the top tax bracket at 49%, you might get a tax credit back, $1,450 or something like that. So that's how it works. Now, from a lender point of view, that's really bad, because if your goal originally was to buy 5, 6, 10 properties, and you're buying negatively geared properties, if your income isn't through the roof, okay, to buy those 10 outright on your own income and not care too much about the rent, your borrowing power figures are going to come in low. All right, there's a big difference between negatively gearing property and positively gearing. I mean, the whole of my portfolio is sitting on a 6 to 8% rental yield. All right, so even though right now my income's quite high, I could have had my income at my last tax return, which is the household income, was just under 210,000, and we managed to get up to 7 investment properties theoretically, because I've got a pre-approval right now. So I've got 6 investment properties, and I've got a pre-approval for my 7th. So we could have gotten 7 investment properties on a household income of less than $210,000 in this country. And a large portion of that is due to how I positively gear my properties. And if I waited another year and I put all the granny flats on the back of 3 of the properties that I bought, maybe 4, depending on if I can fit one on one of them. All right, we're in a position where I could potentially not buy the 7. I could slowly, even if my income stayed at the 210K level, I could have maybe have gone to, from Commonwealth Bank to First Mac to Pepper to max myself out. I could have got into 10 properties. So I got to 7 really quickly with a major. Then you put the granny flats on maybe over the next kind of 12 months. Your income from the rent comes in on that, and then you use that to up your borrowing power. All right, so very theoretically, I could have gone to 9 or 10 properties if I put those granny flats on to boost my borrowing power again. And I guess the case in point on point number 1 is that people aren't doing it that way, so they're not increasing their borrowing power so they can buy their next property. All right, so let's go on to point 2, buyer's agents. All right, so they're across the country, and the last 2 to 3 years they've been flooding in. You've seen all these green young buyers agents with zero experience trying to act and tell you that they understand how property works when they don't. I've been in the lending space for over 14 years. I've seen how the market's been, and the last 2 or 3 years suddenly there's been a flood of buyers agents that have come on the market. Now the ones in Sydney especially have to justify to people why they need to buy these 2 and 1 bedroom units in eastern suburbs that yes is going to grow and has a great growth record. So let's use Bondi as an example, a 1 bedroom unit. You could be paying anywhere from $800,000, but if you're on the water, you could be paying 1.4, 1.5, 1.6 million. So yes, you are getting that growth from the property, but the rent on those properties is normally between about 2.5 to 3.5% max rental yield. Okay, and a lot of the 1.2 mil plus properties, the rental yield is in the 2% range. All right, so that means that a large chunk of money is coming out of your pocket every week to maintain the property. All right, and these buyers agents are trying to justify why you should be buying there and not buying in cheaper cities or higher yield locations. And they talk about blue chip, and they talk about you get the growth here, this is where the incomes are, this is where the professionals are, and they talk like this. And yes, that may very well be the case for your first 1 to 2 properties. If you've got good incomes, you could probably sustain that, get the tax benefits and do well. But very few people that go down that path have the ability to build out a 10-15 portfolio unless your income doesn't ramp up hugely. All right, so that's another thing that we're seeing in the market, and another thing that people see on YouTube and LinkedIn and in the news. And if they go down that path, they're increasing the chances that they cannot buy the 10 properties that they want. All right, the third one, Negative gearing again, but let's think about it from a mindset point of view. Let's not think about it from a mechanics point of view. So mindset is, let's say most people go and get their owner occupied first. They never get their investments and rent vest first. Most people get their owner occupied, and then what they do is they go out and get their first investment property, or half of them listen to these buyers agents, and then what they do is they see their bank account going down every rental period, and it just plays on their mind. Okay, and not just that, they're having to manage economics, job turnover, getting a promotion, the normal stresses of life, watching the news every day, seeing that the market's going to crash 50% every second day, and really it plays on your mind. Okay, and not just that, you need to maintain your jobs and your work to build your portfolio if it's negatively geared. So if you have a period of time where you're not working and you don't have large cash buffers, it plays on your mind, and that's the reason why, if we go back to the article, that's the reason why so many people negatively gear. Okay, let's have a look at this. So 76 out of the 100 negatively gear. And we wonder why people are so stressed that they can't get to 6 to 10 properties. All right, so that's the third one. Let's go to the fourth one. The fourth one. Most people don't set their lives up correctly first to get the end result that they want. Now, let me give you an example. A lot of people, what they do is they fumble through life, and they do it in the way that society and culture and the Aussie way tells you to do it. So they get the owner occupied first. They get they start having their overseas holidays first. They get the children first. They get the SUVs first. They get the 4 credit cards and maybe 1 personal loan first. And then they wonder why their borrowing power is crippled to a point where they can't get to the 10 properties. Okay, so yes, there are definitely ways that even the ones that are halfway through a journey can get to the 10. But it doesn't happen, and you can see in the stats that I've shown you on why it doesn't happen very often. Because not just that, if they start on the journey, let's think about it. Okay, so a lot of people, what they do is they get maybe to late 30s and 40s, and then they go, oh wow, I've been working for over 10, 15 years and we're not getting anywhere, and we've just got the owner occupied, and then they start thinking about the kids' future. But what they don't do is they don't do the cuts in their lifestyle, and they don't do the cuts in how they're running their lives to get the end result that they want. So if they really did cut the SUVs, went and got secondhand 5 to 10 grand cars, they got their kids out of the private school, just go and put them in the public school, they went for their promotion at work, and they really put a concerted plan to transition the majority of their owner-occupied debt recycle it, to put it on investment debt. And if they did that for 3 to 5 years and you went hard, you will achieve financial freedom. But they're not willing to do it. They do it in half commitment and half truths. And then you wonder why you see the stats that we're seeing where barely anyone gets past 2 investment properties. All right, so that's the next one. So most people don't set their lives up correctly for where they want to be. And I use this example a lot, but if you do what everyone does, you will get the same results that everyone else gets. All right, let's go to the next one. 5, incorrect structures. So most people don't target an investment broker from the start. What they'll do is they'll fumble through, and everyone thinks that they can do these kind of structures and are on the same path. And a lot of bankers and lenders will say, deal with me. But at the end of the day, are they investor specific, and are they on the same path themselves? And is there a lot of their clients' investment? And the answer is no. I would hazard a guess that there's about 20,000 mortgage brokers in the market at any one time. Half of them are hairdressers and don't have any experience. Half of them have joined the industry from non-financial, non-accounting backgrounds. The ones that have joined from accounting and financial backgrounds and banking backgrounds, probably less than 10% of them are doing any real volume. Less than probably half of that 10% have a good range of lenders that they use regularly per month. And then maybe another 50% of that would deal with a lot of investors. And probably, again, 50% of that and number deal not just from a book smarts point of view, but they've actually got the 6 to 10 investment properties like I've got. All right, so they're, I would say less than 1% of brokers in the country. Over time they write loans, and eventually some of their clients get investment properties, and I'm not even including them because they're not truly investor focused. So what happens is, and I find this a lot of people feel commitment to the previous broker or banker that they've used, but they don't understand that they've already crippled them at the start. All right, so they've already set up wrong structures. They've already only used basic variable redraw. They don't have offsets. They've already fixed one of their investment loans when they shouldn't do that, okay? Especially during the ramp phase when you've got to be continually revaluing and pulling money out. They're in the wrong bank that has the wrong cash out policy for revaluing properties and pulling money out. They don't know where to go to after they've maxed out with the big 6 banks. So they pick the wrong bank. Okay, and all of these things stack on top of each other where they can't get what they want eventually. All right, so really you need, if you ever think you're going to go down this path, even if you want the 1, 2, or 3, deal with the investment broker at the start. And it doesn't take long for you to watch content on LinkedIn and YouTube or listen to me for more than 5 minutes to realize why I'm different than the majority of brokers out there. Okay, not only from how I speak, but how I talk about structures and getting you what you want. Okay, a lot of people will talk positively and say that they can do it, but at the end of the day, is 80% of their clients doing this daily? And are they up to date with what you should be doing? And, are they doing this in their personal life? And the answer is probably no. All right, so whenever I have someone in front of me that isn't sure whether they should jump ship, I go, well, they've already stuffed up this, and this, and you're still wanting to give them commitment while sitting in front of me and getting all the information that you should have been given at the start. And then if you continue going down that pathway and then come back to me, I'll have to clean up everything. So we might as well start from here, clean it up, get it right for you to get to your next ones, or it's going to be a bigger mess down the track. So that's up to you. All right, so that's point 5. So let's go to point 6. Society and culture is backwards. Okay, and we know this because when we look at society and we speak to mum and dad, they want you to get the owner-occupied property first. Okay, they want you to strive in the one job and get the promotion and then have the holiday every year. They want you to, when you have kids, to buy the $1.5 million property so you're just down the street from the parents so they can help you, but they don't understand with you doing that, they're hamstringing you to a mortgage and pretty much working all your life without financial freedom. Okay, they want you, society, you leave uni, people get jobs. What do? They get cars first. So you got all these people, especially I talk about this with my wife. So my wife is an accountant or in receivables in a trade store, and she sees all these tradies that go through the 4 years to get their trade certificate, and when they've got it, within weeks they turn up with a 50 to 80 grand ute, and they wonder why they've got problems and issues with their financials and tracking what they do with their business, and wondering why they've got to work until they're 60 with manual labor, with bad knees, bad backs and bad shoulders, and they're not setting them up for their future, when really they could get a very similar ute that's very reliable for 10, 15 or 20 grand, but they get car finance and they get a 50 to 100 grand ute, and it happens all the time. And so my wife, she sits with the window over the driveway, and then she sees this new air conditioning guy turn up in this 50 to 100 grand ute, and the kid's not even 21, and they're turning up like that. All right, so society and culture are backwards, and that's shown in the numbers. Okay, you do what everyone else does, you get what everyone else gets. Okay, you get the same results. So the answer is you need to do it the opposite way to get the results. Okay, so that's that point. Let's go to point 7. Buying the wrong property as the first or second one cripples your journey. All right, so in a very big nutshell, most people get gun shy. One, if they bought the wrong property and it produces bad results. So one, they purchase a property and it starts having issues with the they didn't do the building report properly, or they didn't structure their mortgage properly, or they didn't do a whole, like they bought a heavily negative geared property, and then there's a big difference between the concept of negative gearing and actually seeing the money come out of your account every week and how it plays on your mindset. All right, so really you're buying the first one, and not just that. Let's just talk about location. Imagine if you were in 2006 and you were purchasing in the Perth market in Australia. It was booming. Everyone was making money. Tradies were making money hands over fist. Most of them were on 150, 200, 250 grand for diesel mechanics back then. Making big money, making overtime, unlimited, riding the boom. And then they bought the property, and then what happened? They went through a downturn where there was a 20 to 40% correction on all the prices, and they still haven't gotten back up to where they were 14 years ago in some of those areas around Perth. Okay, so they bought, 1 or 2 properties in the wrong area at the wrong time with the wrong kind of rental yield and type of property, and most of it was negatively geared, and then they wonder why they don't get 6 to 10 properties and financial freedom. All right, so that's point 7. Point 8. Not setting timelines and buffers to protect what you've got. So I'm going to use myself as an example. Right now in my business, I keep anywhere from about 40 to 50 grand in my business account. All right, that's for setting aside for my tax, my BAS, and any short downturns. All right, and then what else I do is I, depending on how many properties we've got, I keep larger and larger amounts of cash in our account. So yes, I could potentially, in my ramp phase, continue buying and dropping the cash balance down. But the larger the portfolio gets, the more risk there is in something going wrong in the portfolio or something happening with me or my job. Okay, so I always want to keep larger and larger amounts in. So at the moment, we're keeping, give or take, 50 to 75 grand in our account. All right, and when I stop buying and I put the granny flats on, we're going to get to a stage where I've got between kind of around 8 to 10 properties, and I'll be sitting about 100 to 150 grand cash minimum in my offsets. All right, then the rest can go into super, can go into shares, can go into this or that or the other. All right, but that core amount of 100 to 150 grand cash sits there as a buffer if anything goes wrong. So if you go through a ramp phase and you're not thinking about these concepts, then anything could happen, a life event, health, get sued by someone, anything like that. One of your partners passes away, anything. Really, you could be trying for kids, and even though it's a great concept, you could come out with triplets, all right, and your expenses go through the roof. So you need to have these kind of things in your thought process, but not just that, your timelines. All right, some people go way too quick, okay, and again, not have the buffers, go too quick, and then they blow up. All right, so timelines and buffers. That's point 8. Now 9, no mentor. All right, so a lot of the time, if you're going down this path and you're not dealing with someone that's already on that path or already at that point that you want to get to, you're not dealing with the right professionals. Okay, my accountant, my lender, my fin planner that's going to do some of my insurances and things in the future. Okay, and my property manager and my buyer's agent. I've got all these professionals around me, and every one of them is a professional investor in some way, shape, or form. And I need them to be, because not only, yes, I would consider myself my own mentor, because I'm one of the few that has the lending experience, has the investment experience, understands all the markets, and I talk to investors pretty much every day of the week. So I've learned as I go, and I'm one of the few that don't need a mentor, but most people do. So if you've got a broker or a lender and you ask them how many investment properties that they've got, and they either don't answer the question, or if they do, they don't have 6, 10, 15 properties and where you want to be at, then they're just book smarts. They know how to deal with the lender, and most of the time they're not giving you examples of what they've done in the past. And most of the time, if they don't do that personally, a lot of their clients are not investors on that same path as well. Because whatever you put out in your marketing, in your messaging, is the type of client that comes towards you. All right, and that's why everything that I do and focus on talks about investors, because that's the path that I'm on. Okay, and that's the path that the majority of my investors are on, and probably about 70 to 80% of my clientele right now is investors. All right, and just slowly over the last 4 years, that percentage has increased at every point. All right, so they don't have a mentor, so they don't have either their lender, their mortgage broker, their accountant, their buyer's agent. Someone's not mentoring them through these steps. Okay, number 10, listening to friends and family, especially the ones that aren't on the same path that you want to be on. All right, and that's just very self-explanatory. What I found was, especially when I was on the second and the third one, I was getting all this talk by friends and family that had all these opinions. And the funny thing is, those opinions have nothing to do with me. They're not paying my bills. They're not taking my risk. They're not trying to get financial freedom like me. They're not on the same path as me. So why would I listen to them? Okay, why would I listen to them if I want financial freedom and they clearly don't have it and they're not on that path? All right, so that's the 10th one. So if you're liking these kind of videos and what we're talking about, the concepts and things like that, please hit the subscribe button, hit the like button, hit the notification bell, and we've got to hit that YouTube algorithm as hard as possible to get this good content out there so people can see this. We're trying to improve people's lives and chances of achieving financial freedom. Not a lot of people in this world talk about money, investments, financial freedom. And not just that, many attack it from the stocks point of view, but not many attack it from the real estate point of view. And I want to be one of those ones that's showing you personally what I'm doing, how I'm doing it, and I hope that adds a lot of value. And just bear in mind, you're always speaking to your professional and getting advice from them. So your accountant or your financial planner. I cannot give specific advice, but the reasons why I can do these kind of videos is that I'm doing it personally and I'm showing you what I'm doing. I'm not telling you what to do or not to do. I'm just talking about what I'm doing, the concepts and what I think about, and just giving you as much knowledge as I have, from personal experience. And I hope that that's adding a lot of value. All right, so if you're liking these videos, hit that subscribe button, okay, hit the notification bell, hit that like button for the YouTube algorithm, and let's get these videos out to as many people as possible. I'll see you on the next one. All right, bye.